Hello friends, this is Professor D.A. Kulkarni. Welcome to all of you to video number 10 of Advanced Financial Management. The topic is Economic Value Added and example number is 4. So please check out the example. So example is in front of you. Example number 4. Income statement is provided. All the amounts are in lakhs. Sales 5,000, interest on investment 100, profit on sale of asset 50, total income 5,150, less manufacturing cost 1,800, administrative cost 600, selling and distribution cost 500, depreciation 300, loss on sale of building 50. So total cost 3,250. EBIT as per this example 5,150 minus 3,250 1,900 less interest on loan 72, earnings before tax 1,828 less tax at the rate of 30% 5,048.4, earning after tax 1,279.6, earning per share EPS, that is earning after tax divided by number of equity shares, rupees 25.60, and market price of equity share is also given, that is rupees 160. Along with this income statement, balance sheet is also given to us. Liability side, equity share capital of rupees 10 each 500, retained earnings 400, 12% term loan 600, trade payables 150, provisions 130. Asset side, building 800, machinery 700, stock 100, debtors 120, cash and bank 60. So total of the balance sheet both the side 1,780. Now this asset side is actually irrelevant for us for calculating EVA. We are mainly concerned with the liability side. Now the new thing in this example is that net operating profit after tax is not given you directly. Even net operating profit before tax is also not given you directly. Debt and equity also not given you directly. You will have to identify out of this liability side on balance sheet. And the third component, weighted average cost of capital, is also not given us directly. Even the specific cost of each capital, that is a debt and equity, is also not given us directly. That also we will have to calculate. So net operating after tax, net operating profit after tax, we can find out with the help of this income statement. Amount of capital invested, that is a debt and equity, we can calculate with the help of balance sheet, and that is our specific cost. To calculate the weighted average cost of capital, specific cost we can find out with the help of income statement and balance sheet. Now the first we'll have to calculate net operating profit after tax. But you can check out here various items of income side are given. 3 items are there on income side, and cost also 5 items are there. Whether all are to be considered or not, that we have to discuss now. So let's proceed for the solution. This is solution. First working note, that is to find out the first component of operating profit after tax, NOPAT, that is how to calculate operating profit, sales minus operating expenses. We have already discussed this one in our introduction video. So sales minus operating expenses is equal to operating profit before tax. Check out, sales minus operating expenses is equal to operating profit before tax less tax is equal to net operating profit after tax. So out of our income statement which is given in the example, we have to identify and find out these relevant information. So here we are going to consider only the sales. You can check out in income statement in the example, Three items are there on income side: sales, interest on investment, and profit on sale of asset. So out of these three, we are going to consider only the sales because that is our operating revenue. That is revenue. That is operating income. Other items are non-operating income or indirect income, which we are not going to consider. So out of which we will consider only the sales. Sales amount is rupees 5,000. So sales 5,000. Less operating expenses. Now in operating expenses, what we consider only manufacturing expenses, administrative expenses, selling and distribution expenses, and depreciation. Other than these four items, nothing will be considered as a part of operating expenses. Though you can check out in the example, manufacturing cost is there, administrative cost is given, selling and distribution cost is given, depreciation is given, and also loss on sale of building is given. And total of this cost is 3,250. But out of this, loss on sale of a building we are not going to consider because this is not an operating expenditure. This is non-operating expenditure, non-operating loss. So we are going to consider only these four items. So first one, manufacturing cost, amount 1,800. So manufacturing cost 1,800. Administrative cost, check out administrative expenses 600. So administrative expenses 600. Selling and distribution expenses. Selling and distribution expenses 500. Depreciation. Depreciation rupees 300. You can check out the total. I have given the formula. So total of all these four items, 1,800 plus 600 plus 500 plus 300 is equal to 3,200. Now the operating profit before tax, sales minus total operating expenses. 5,000 minus total operating expenses 3,200. So operating profit before tax is rupees 1,800. Less tax at the rate of 30%. How I have got this rate of 30%? Check out, it is given in the example. Example, this is our income statement and here it is mentioned that less tax at the rate of 30%. So 30% is the tax rate. So less tax at the rate of 30%, amount is 540. So net operating profit after tax 1,260. This is our first component, net operating profit after tax. Now second working note, to find out the second component, capital invested. So capital invested is equal to equity plus debt. Equity, what consists of equity? There is a share capital plus retained profit, means reserves and surplus. Now share capital includes equity share capital as well as preference share capital. Now just go to the example. In example, balance sheet liability side, we can find these items. Now here no separate preference capital and equity capital is given. Only one amount is given as a equity share capital. So equity share capital is rupees 500 and retained earnings rupees 400. So this is 500 plus 400. These two will be the part of equity. So equity share capital 500, retained profit 400. So total equity will be rupees 900. Check out 500 plus 400. Now the debt. Debt means what? Long-term borrowed fund. So we can check out on the liability side. So this is after equity capital, share capital and retained earnings. There are the three items. That is a 12% term loan, trade payable and provisions. But out of these three, only one, this one is a loan, that is a borrowed amount. And this is a term loan. It means we assume that it is long-term loan. So long-term borrowed amount is rupees 600. So 12% term loan 600. So total capital invested will be 900 plus 600. That comes to rupees 1500. So total amount of capital invested is 1500 and net operating profit after tax is 1260. So we have got two component of EVA. Now we want to calculate third one, that is weighted average cost of capital. To calculate the weighted average cost of capital, what we require? We require the specific cost of debt and equity and the amount of debt and equity. So amount of debt and equity known to us, but the specific cost of debt and equity are not given to us. We will have to calculate. Now here, check out. Here the two small working notes are prepared. First one is cost of debt. Cost of debt, the formula is I 1 minus T upon SV. I means that is interest. 1 minus T. T stands for interest rate. Divided by SV means sale value of that debt. So I stands for interest. Check out, interest amount is given in the income statement. Less interest 72. Also you can check out, cross check. Here in the balance sheet, term loan is given of rupees 600. Interest rate is at 12%. 12% of 600 comes to 72. Now you can calculate the amount of interest and then you can calculate the cost of debt, or directly with the help of this interest rate also you can find out the cost of debt. So we will try with the amount of interest. So amount of interest is 72. So that is 72 into bracket 1 minus T. T stands for tax rate. So tax rate is given to us 30%. 30% means we will consider as a 0.3 bracket complete, divided by SV. SV means that is a value of debt, total sale value of debt. So amount of debt 12% term loan is 600. So that is 600. So 72 into 1 into bracket 1 minus 0.3 divided by SV, that is a 600. Now we have to find out, we have to solve this equation. So that is equal to 72 into bracket 1 minus 0.3 bracket complete divided by 600. Now we have to find out this cost in terms of percentage. So we will multiply with 100. Just check out, interest 72 into bracket 1 minus T, that is a 1 minus tax rate, 1 minus 0.3 bracket complete divided by 600 into 100 is equal to 8.4%. So we have got the cost of debt by 8.4%. So this is 8.4% is the answer. So that is a 8.4%. So here we have got the specific cost of debt by 8.4%. Now we require the cost of equity. Cost of equity. How to calculate the cost of equity? We know that there are the three different approaches for calculating the cost of equity. Traditionally, dividend approach, that is a D upon P, dividend per share divided by market price of share. Second approach is earning approach, that is a E upon P, earning per share divided by market price of share. And third approach is growth approach. Growth approach, D1 upon P0 plus growth rate. Now out of these three approach, we have to check out what information is available to us in the example. So if you look at the example in income statement, after the earning after tax, earning per share is given to you. That is a rupees 25.60. At the same time, market price of equity share is also given. That is rupees 160. Means earning per share and market price per share is given. So here we can follow the approach. There is a earning approach. Earning approach, that is equal to E upon T. It means Earning approach E upon P, that E stands for earning per share and P stands for market price per share. So EPS 25.60 and market price is rupees 160. So here we can calculate cost of equity. KE is equal to E upon P. E is equal to earning per share, that is rupees 25.6 divided by market price. Check out once again, we will confirm it. EPS 25.6, market price is rupees 160. So divided by 160. So 25.60 divided by 160, we will calculate it. 25.6 divided by 160 into 100, as we have to find out the percentage. Now that comes to 16%. It is 16%. So cost of equity comes to 16%. So specific cost of equity is 16%. Now we know the amount of debt and equity. We know the specific cost of debt and equity. Now we have to find out the proportion or weight of debt and equity on total capital. That is debt. Debt amount is 600. So proportion of debt on total capital. So that is a 600 on 1500. Here I will calculate once again. 600 divided by 1500. That comes to 0.4. And equity 900 upon 1500. So 900 divided by 1500, that comes to 0.6. So these are the weights. Now we want to find out weighted cost, that is equal to specific cost 8.4 into weight proportion 0.4, that comes to 3.36%. Equity 16% into 0.6, that comes to 9.6%. Now the total weighted average cost of capital 3.36% plus 9.6%, that comes to 12.96%. So this is our weighted average cost of capital or WACC. So here we have got all the three components. Net operating profit after tax 1260, capital invested 1500, and weighted average cost of capital 12.96%. Now let us move to calculate EVA. EVA is equal to net operating profit after tax minus into bracket capital invested into weighted average cost of capital. So that is equal to net operating profit after tax 1260 minus into bracket capital invested rupees 1500 into what? WACC, what we have just calculated. WACC is 12.96%. So it is 12.96%. Bracket complete. So 1260 minus into bracket 1500 into 12.96%. My EVA is equal to 1066. You can check out. EVA is equal to 1066. So this is our final answer. Earning economic value added is equal to 1066. So actually this amount is in lakhs. So this is 1066 lakhs because all the amounts are in lakhs. So final answer is EVA is equal to 1066 lakhs. I hope you understood this example. अगर आपको पसंद आया इसको लाइक करो, शेयर करो. If you have any query, you can write it into the comments. Or also on the beginning of the video, my email ID is also given. So even if you want to mail me, you can mail your queries. I will definitely answer all the queries. Thank you very much.